Hi, everybody. Before we begin, I'd like to have a general disclosure that the information in this webinar is educational and general and not meant to be investment advice nor product recommendation. For margin requirements, please check with your respective brokers or the CME website. So today's outline agenda, first we'll be covering what is interest rate and the US Treasury market, and also going through certain fundamental bond concept, like why is there inverse relationship between bond price and bond yield, the concept of duration, and what is DBO1 and how do you calculate that. Also, we'll be going through the introduction to Treasury and micro Treasury futures, which I will touch on it to give the context of why yield futures are actually a friendly alternative. So bulk of the time in the presentation we spend on the portion of the yield futures. Then we move on to the current interest rate and the Fed outlook. And lastly, I'll be going through four applications of yield futures and the case study. And then we end up with a question and answer session. So what is interest rate and who actually sets them? So interest rate, if we put it simply, is the cost of borrowing money. And actually it affects the economy via various transmission mechanisms. So certain examples include, like for individuals, it affects what you get out of your savings rate, the deposit rates that you put when you put your money in the fixed deposit with a bank. It affects your housing loan, your car loan, in terms of how much you pay. For corporations, affects the decisions whether they want to invest in expansion. And even for government who borrow to spend on infrastructure, social security, defense, they need to borrow and they need to pay interest payment on this debt. For financial asset, the price of them is actually the present value of expected future cash flow. So interest rate obviously will affect the valuation of this financial asset. And in terms of currency, typically a higher yielding interest rate currency would attract inflow and be stronger versus one that is of a lower yielding. So who actually set interest rate and monetary policy? The US Federal Reserve is the most important central bank in the world because number one, the US dollar, as we all know, is the reserve currency of the world. And number two, the US is the biggest economy in the world. It's often said that when the Fed sneezes, the rest of the world gets a cold. That is how important they are. So the Federal Open Market Committee, otherwise known as the FOMC, is actually a branch of the US Fed that determines the direction of monetary policy. And in 1 year, they hold 8 regularly scheduled meetings. Although if the economic conditions call for them to hold something outside of these 8 meetings, they can, like we see in COVID. So the last meeting was on the 1st of May, where they did nothing. And the next meeting would be on the 12th of June. So market will often attempt to predict whether the Fed will tighten, otherwise known as being more hawkish, or ease, also known as being more dovish, their monetary policy, with a resulting increase or decrease in interest rate. So it's also very important to note that for the Fed, they have a dual mandate for monetary policy. That is, to try to attain maximum employment and price stability. So it's good to sometimes picture the Fed as a doctor. So if the economy is feeling very hot, having a fever, they will administer the medicine to bring down the fever. So fever in this case would be inflation. Or if the economy is very cold, the patient is very cold, they will give the respective medicine to try to bring the body temperature higher. And that medicine in the context of the Fed is interest rate. So with that backdrop in mind, what is the US Treasury market? So earlier I mentioned that the government also have to issue debt to borrow money for their spending. So the US Treasury market is the largest and most liquid interest rate market in the world. And as of now, the estimated total outstanding debt is about 34 trillion, which is a very staggering number. So the US Department of Treasury, which in other countries will be known as the Ministry of Finance, they will issue this bond to raise money. And at auction, this will be known as the primary market, And after that, they can be bought and sold in the secondary market. It's also important to note that the US Treasuries are viewed by financial market participants to be a safe haven or flight to quality instrument. And they are backed by the full faith and credit of the US government. So this is a chart of the public debt of the US government. Currently is hovering about 99% of GDP and is projected to keep increasing. The CBO forecast is for this to continue increasing as they borrow more money down the road. So for the US Treasury auction, this is the schedule. The common term used for on the run means the most recently issued US Treasury. So when there's a next auction, those that were formerly on the run become off the run. So it is also useful to know that for US Treasury, it's often divided into bills, which is the maturity below 1 year, notes, which is up to 10 years, and also bonds for maturity greater than 20 years. So for bonds of different maturity, they are often traded at different yield levels. And this is also known as the term structure. This term structure can be upward sloping, downward sloping, or flat. And it reflects market participants' expectation of changes in interest rate and monetary policy, and also the economic growth outlook of the economy. So you can see from the diagram here that the current US Treasury term structure is now one of a downward sloping. In fact, it's an inverted curve because the front end yields, as you can see from the chart, is at a much higher level than the long end yield. So before we go into the actual yield futures, it's very important to understand a few fundamental bond concepts. So for some of you, you always hear that bond prices and yield are negatively correlated. There's an inverse relationship between them, meaning when interest rates go higher, you expect bond prices to fall. Similarly, when interest rate goes lower, you expect bond prices to rise. But actually, there's a mathematical formula behind this. If you look at this, the price of bond simply will be your first coupon and the subsequent coupons that's being accumulated all the way to the principal. Then you have to discount all this cash flow back to the present value. That gives you the price of the bond. So the discount factor here is the interest rate. So in the denominator, if it goes higher, ceteris paribus, the price of the bond drops. So this is actually how the relationship is being derived. So when interest rates go higher, present value of the future cash flow gets smaller, the price of the bond is lower, and vice versa. There's also a very important concept in bond known as duration. So simply put, you can view it as something like a sensitivity of a bond to interest rate changes. It can be up or down. So how much will the bond price change if interest rate changes? People often confuse this with the bond term to maturity. A duration is only equal to a bond term to maturity if it's a zero coupon bond. That means if it's a 10-year zero coupon bond, the duration is 10. But in reality, the duration can be affected by a bond's maturity, yield, and coupon. So generally, the longer the maturity, the higher the duration. Higher the yield, higher the duration. So you can remember this by a higher duration means the bond is more sensitive to interest rate changes. So it's not necessarily means that higher duration is bad, because it just means it's more sensitive to interest rate changes. So if you look at the table, you can see that for a 2-year Treasury bond, the duration is approximately 1.85 now. So if there's a 1% interest rate change higher, the bond price is expected to drop by 1.85%. This is the inverse relationship we mentioned earlier. And then for a 10-year bond, the duration is 7.95. So you can see that it is higher than 1.85. So similarly, for 1% interest rate change higher, the bond price is expected to drop by 7.95%. So this concept of duration means that higher the duration, the more sensitive is the bond price to interest rate changes. So from duration, there's a concept known as DVO1, which is the dollar value per 1 basis point change. So duration is a concept of sensitivity. DVO1 numerize the concept, meaning it will show you an actual dollar value of the change in price of a bond for every 1 basis point change in interest rate. So what is a basis point? A basis point is simply 100 of 1 percentage point. So 1 basis point is 0.01. It's 1 divided by 100 of 1 percentage point. So how do you calculate DVO1? So if we take an example of the 10-year US Treasury note, we call it 4% 10-year note maturing in February 2034. The last price is 95-17. Notice the 17. Because for US Treasury bond, it is very unique in the sense that it is quoted in 30 seconds. So simply take, if you see on the screen, it's 95-17 means that it is 95.17 divided by 32. So in this case, the price is 95.53125. So they trade in increments of 32s. The modified duration, as mentioned earlier, 7.95. The yield is 4.57. So the cash price is 95.53125% of the 100,000 face value. That is the cash price. So how do you calculate DVO1 in the theoretical academic way? You will take how much is the absolute price change for 1 basis point higher. You add it up with the absolute price change if interest rate were to move 1 basis point lower. You take the average of the two. So in this case, when the interest rate goes down by 1 basis point from 4.57 to 4.56, the bond price is expected to increase, and it increased by 76.39. Similarly, for 1 basis point increase in interest rate, the bond price decreased by 76.32. So you take the two up, you sum, you get the average of the two is 76.36. So this is your actual DVO1 value. But in practice, it's very hard for you to be calculating it this way. So for market practitioner like ourselves, we actually use the modified duration way to calculate. And this is an approximation method, which generally is okay for relatively small changes in interest rate movement, and it's a good approximation. So you take the DVO1. To calculate the DVO1, we take the modified duration, we multiply it by the price, and we times 0.0001. And then you actually get the DVO1 of 75.95, which is very, very close to the so-called quote-unquote proper way of deriving at 76.36. So in general, we can say that the longer the maturity, the greater the duration risk and price sensitivity, the larger the DVO1. So this is a relationship in general. So now that we are done with the fundamental bond concept, we now move on to the US Treasury futures. So this is what institution traders typically trade. And the first US Treasury futures, we also call it classic, were first launched in 1977. And it had been traded by the likes of bank traders, insurance firms, hedge funds, mutual funds. So everybody that needs to either put on a US Treasury future bond exposure via derivative, this is a very, very common and popular way, and hence it's very liquid. But it's also very complex. If you look at the table, you will see that there are many tenors, 2-year, 3-year, 5-year, all the way to Ultra T bond, which is trying to represent 30 years. You can see that the face amount are also all different. For the smaller note, it's at 200,000, and then it's 100,000 for the 5-year note and above. Then there's something known as deliverable maturity. So there is a basket of securities that can be delivered into the futures. And for every note is defined differently. Then there are 4 contract months in March, June, September, and December. And the confusing thing is more on the tick value, because earlier, if you can recall, I mentioned that US Treasury bonds are traded in 30 seconds. So it is the same way the Treasury futures are also priced, the convention for pricing them. And hence the tick value you can see for this table, there's also a range from 7.8125 to 15.625 all the way to 31.25. So it is very confusing for somebody that is not exposed to interest rate, not exposed to futures trading, and the notional tends to be very, very big. Hence, it's very suited and has been traded by institution players. So for the classic US Treasury securities, there's a concept known as cheapest to deliver. So it is derived because this institution, this classic US Treasury futures are physically settled. When we say physically settled, it means that the short seller, they have an obligation to deliver the actual underlying bond to the holder of the futures, to the buyer of the futures contract. However, the short seller can choose when they want to deliver and which eligible security to deliver, because there will be a basket of securities, and then they can choose one bond to deliver. So the question of which bond do they choose? So for the seller, they always want to choose the bond that is so-called the cheapest to deliver. So in our jargon, we call it the CTD. So the CTD will be the bond with the highest implied repo rate. So it is. So how do you derive this implied repo rate? So it is a theoretical rate that assumes that if you buy the cash security, you sell the futures contract to hedge against it, you lend the cash security in the repo market, and then when it comes to maturity, you deliver this security into the futures contract. So there will be a basket of bonds, and the bond that gives you the highest implied repo rate will be the one that is the cheapest to deliver. So the physical settlement, I'm not going to go into detail. The actual delivery process is a 3-day event, and you have to adhere to the dates to deliver the bond to the holder of the futures contract. So this is a screen on how the cheapest to deliver bond is being selected. And TYM4 is the 10-year June contract 2024. So there's a naming convention, which we will not go into detail today. This function, if you have a Bloomberg terminal, you hit DLV, it will show you the cheapest to deliver bond for this particular contract. So you can see for this contract, the highest implied repo rate is at 5.032, and this will be the security that is Treasury 4.25% coupon, February 2031 security. And notice that there's this conversion factor here, 0.9069. So earlier we were showing the method of calculating the DV01 for a US Treasury bond. So how do you calculate the DV01 of a Treasury futures contract? So what is a derivative? A derivative derives it's a financial, a futures is a kind of financial derivative. And the word derivative comes from the derive. So a price of Treasury futures is derived from the underlying, which in this case is the price of the CTD Treasury security. So every single cash bond that is eligible for delivery into the futures contract will be assigned a conversion factor. So on this page, you can see that there's different conversion factor. So what is the conversion factor for? Because think of it as a concept of you need to equalize different bonds so that you can value them on the same page. So the conversion factor does that. And there's a way to calculate this conversion factor, which will be out of the scope of this presentation. But note that if you want to get a futures DV01, we'll take the cash bond DV01, divide by the conversion factor, and you can derive the corresponding DV01 for the futures. So a very quick case study on how to use a classic Treasury futures to trade. Note that this will be traded in price term. So for example, this is a hypothetical case study that the trader believed the US economy will keep strengthening and that the US Treasury yields will rise. So to express this view, so he thinks that the yields will rise, meaning that he thinks the price will fall. So because the classic Treasury futures are traded in price terms, he therefore must sell the contract. So he proceeded to sell 10 contracts of the June 2024 10-year Treasury note futures at 108-08. So remember earlier I said that these are quoted in 30 seconds. So this simply means it's 108-08 over 32, which is also 108.25. So his view turned out to be correct. And the price of the TYM4 actually dropped, meaning the yields rose. So he went back to buy back. He went to buy back the TYM4 futures note at the lower price of 107-10. So notice that there's a big figure change from 108 to 107. So how many ticks is this equivalent to? So from 108.08 to 108, there's actually 8 ticks. And then you cross to the new big figure. So from the new big figure of 32 to 10 is another 22 ticks. So altogether is 8 plus 22 is 30 ticks. And the minimum tick value of the 10-year note is 15.625. So quickly, let me show you. It's here. This is the minimum tick value. So the 10-year note is at 15.625. So the formula is very simple. It would be the number of contracts times the number of ticks. So times the dollar value. So it will be 10 contracts times 60 times 15.625. It is 9,375. So this is the calculation of a P&L of the US classic Treasury futures. So what is the micro Treasury futures? So earlier, the example we went through, the table that I showed, is what the institutional players typically trade in. It's the most liquid Treasury futures out there, but it is typically in a very big notional size. So CME has actually introduced 2 Treasury futures, which are called micro Treasury futures. So one is for the 10-year and one is for the Ultra T bond. So for these two, the main difference is cash settled. So there's no need to worry about what is the cheapest bond, cheapest to deliver bond. There's no need to worry about operational risk because everything is cash settled for the micro Treasury futures. And the other important point to note is everything is 1/10 of the classic. So you can see from the table here, the DVO1 is 1/10 or 10% of the classic Treasury futures. The tick size instead of 15.625 is 1.5625. Even the margin is also approximately 10% of the classic Treasury futures. But it's also very important to note that the convention for trading this is still in price term, which is like the Treasury bond is like the classic Treasury futures. So I'm going to take a pause here and recap. So far, we have talked about what is the US Treasury bond market, and then we move on to talk about the US Treasury's classic futures, which is derived from the underlying US Treasury bond. Then we also talk about the slightly more retail-friendly micro Treasury futures, which is cash settled, which is 1/10 the size, but however, it's still traded in price term. So that is the background. Today's focus is actually on yield futures. So the earlier time we spent is to give some fundamental concept, which will be very important to understand yield futures. It's also to give a context of why yield futures were introduced to actually let the average investor be more comfortable with it. So I started my career as an interest rate trader in a bank. So there we were trading a lot of those TYs, FV, which is the classic treasury futures. So I often thought to myself, why do people not trade interest rate? I think why do the average investors, you can see them very active in stock market, you can see them very active in forex. Why are people not trading interest rate? I think the reason are two. First, a lot of people don't really understand what are the drivers of interest rate and how they actually move. I think the second reason is there are not enough tools for people to actually, even if they have a correct view of the economy, there's no appropriate tool for them to use to express their view. Unlike forex, unlike stock market, where if you think the prospects of a company is good, you think you like the company, the share price going higher, you buy the stock price. So for interest rate, I think this was lacking. But I think the CME futures have 5 very interesting features that could actually encourage more adoption, more people to express their view in interest rate. Because the earlier, even for micro treasury futures, while they are more retail friendly in terms of the size, being 110, they are still traded in price term. And they are still traded in 30 seconds. So these are not very intuitive to a lot of people. Because sometimes if you think of interest rate going higher, but you still must think back that the price is going to fall. And then it's not very intuitive to think in inverse relationship. And then secondly, to think of trading in 30 seconds is not very straightforward to a lot of people. So for CME futures, the number one advantage is they trade in yield and not price. So it's very straightforward. If you think interest rate is going lower, you sell it. If you think interest rate is going higher, you buy it. And number two, it is cash settled. So this is a similar feature to the micro treasury futures, but compared to the classic treasury futures, this is very, very good for retail or the average investor because there's no requirement for physical settlement. You do not have to worry about the cheapest deliverable bond. You don't need to worry about whether you have a custodian to take delivery of the bond should you be holding a long futures contract. And there's no operational risk. And the number 3 key feature is the contracts are very small size, and so they allow for granularity for the CME futures. The minimum price increment is 1/10 of a basis point. So earlier we said 1 basis point is 1/100 of a percentage. So you can imagine that it's very, very granular here. And 1 basis point is $10 here. So we're talking about a minimum price fluctuation of just $1 per contract. So it's very granular for the CME futures. And unlike classic treasury futures, which I mentioned earlier, that they have a basket of eligible securities for delivery, there's nothing of this year. They only follow one single on-the-run security. And the last point, which I think is a very key feature, is the DVO1 is a fixed DVO1 for the 4 different maturity of 2-year, 5-year, 10-year, and 30-year yield futures contract. So this is a very important concept because let me quickly flash back to the classic treasury futures. You can see that for this, the note face amount, the notional amount are all different. So if you buy a 5-year note, 5 contract of a 5-year note versus 5 contract of a 2-year note, number one, your face amount is different. Number two, your duration is different. So you will end up with a very different DVO1 for the same number of contracts. So it makes market neutral strategy a little bit more difficult to calculate. It makes DVO1 calculation a bit more complex. Whereas for the yield futures here, fixed risk exposure of $10 per contract, regardless of maturity that you trade, is a very, very neat and very, very convenient feature. So these are the 5 features of the CME futures that make it, I think, very, very attractive, very simplified, for the average investors who could be unfamiliar, with trading interest rate. So quickly touch on the contract specification for CME Group yield futures. It's $10 per DVO1. It also trades pretty much round the clock every day. I mean, almost every day, almost every weekday. The contracts will be 2-year, 5-year, 10-year, 30 years. And then, unlike the classic Treasury futures, which have 4 contracts per calendar year, every quarterly, there will be monthly contracts for the CME Group U futures. And the settlement would be cash settlement and not physical settlement. So that it's also good to know that this broker tag will be the one that is, or rather, the U futures contract will be tracking the broker tag US Treasury benchmark. So this broker tag US Treasury benchmark will be calculated 4 times a day. The timings are as published, and they will they'll focus on the run US Treasury bond for the tenor below. So this table, I extracted it from the CME website, so you can actually go to the same website and search for this very easily. So the broker tag will actually publish the rate, which actually reflect the transaction and executable orders during an observable 15-minute window. So earlier I mentioned that the DVO1 is constant. So look at the dark blue bar for the CME futures. So they are all constant at $10 per contract. Whereas if you look at the classic Treasury futures, the DVO1 will not be constant. So depending on the, for the same number of contract, because of difference in duration, the DVO1 will also vary accordingly. So this is a very, very important feature to note for the CME futures. So when you look at the broker tag, you're looking at the on-the-run Treasury U futures, which is the Treasury U levels. So these are the actual US Treasury bond. But we know that Treasury futures and the underlying Treasury bond, the prices can be the same, or in most cases, they're not, they will be different. They could be, the futures can be trading at a higher level or a lower level. So when is the case when the U futures level is higher than the underlying OTR U? So when the carry is positive, i.e. more than 0, the U futures will be trading at a higher level than the on the run. And similarly, if the carry is negative, the U futures will be at a lower level. So hypothetical example, if we look at the one month CME term SOFR at 5.31, so imagine this to be like our 1 month, we call it the Singapore, the SORA rate, that means, the interbank rate kind of thing, where it's a benchmark for term repo to borrow at 5.31%. The mid yield for the OTR 10-year note published on broker tag is 4.5725%. So since your financing cost, your borrowing cost is higher than what you get on the yield of the Treasury bond, the carry is negative in this case. So it would be a case of scenario 2. So you would expect the futures yield to be showing a lower value than the broker tag pitch yield of 4.5725%. So in this case, the mid price of the U futures is at 4.56. So similarly, in an upward sloping U curve where the long end U could be at 6%, which will be higher than the 5.31%, you expect that the carry to be positive, and in that case, the U futures would be trading at a higher level than the underlying OTR U. So this is how the relationship between the U futures and underlying OTR Treasury U is being derived. So to have a very quick illustration where we compare the classic Treasury U future, classic Treasury futures to the U futures, the price convention for U futures, as the name suggests, you are trading in U terms. Classic Treasury futures in price term. Settlement will be cash for the U futures, physical settlement, physical delivery for the classic. The underlying would be the broker tag 10-year U benchmark index, whereas for the classic, it will be a basket of deliverable securities. Contract size, very important, the DVO1 is constant for all maturity, is set at $10 per contract for the U futures, whereas for the classic, it varies. And the tick size is 1/10 or 10% of 1 basis point, which is at $1. Whereas for the classic futures, depending on the tenor, it can range from 7.8125, 15.625 to 31.25. The initial margin is also lower. Contract listing, instead of quarterly contract, it will be 2 monthly contract. So this is the table to sum up the main differences. So what is the current market and how have interest rate moved for this year? So if we look at the US economy, remember earlier I mentioned that the Fed has a dual mandate of maximum employment and price stability. So employment in the economy means how good the economy is doing. It's affected by a lot of factors. So the US economy has been doing relatively well, if not very, very robust for the last few months. So you can see the blue line for manufacturing, it has actually crossed the 50 mark, which is the line that economists generally regard as above 50 means the economy is starting to expand. So you can see the US manufacturing PMI actually starting to recover. So same for the ISM orders. And in terms of US employment, until 2 weeks ago, where the non-farm data started to disappoint, start to come in below consensus, the previous few months have always exceeded employment. In fact, exceeded expectations. In fact, the month before last was at 303,000. So that kind of number you don't associate with a recession. It's a very, very strong number. Then in terms of the average hourly earnings of the US people, it's also very high. The April AHE on a year-on-year basis at 3.9% is higher than the long-term average of 3.07%. If you look at the red line, that is the Fed's target of 2%. You can see that we are still quite some way above the Fed's target. Even labor conditions are very, very tight. If we go all the way back to the 1960s, we are now having the longest streak of sub 4% unemployment at 25 months. This is a very, very strong labor market we're talking about. Even the initial jobless claim on the right, you can see is also falling below the moving average. So it is a picture of a very, very strong labor market in the US. Even for GDP, the last reading is slightly below expectation, but before that, we were seeing very robust real GDP growth of 3 to 3.2%. Q1 is slightly weaker at 1.6%. However, if you look into the component, it's actually pretty solid, driven by consumer spending and fixed investment. So the picture of US GDP is also one that is very robust, very steady. So, in the last 1 year, I think economists were generally expecting the US to be going through a hard landing scenario this year, because they feel that rates at a very restrictive level will affect the level of economy, affect the level of economic activity, and the US will start to go through a hard landing and potential recession. However, if you look at the actual data, the US growth actually exceeded 2% for 6 straight quarters until Q1 2024. So I think the narrative has changed from a hard landing to a soft landing, and then to potentially, no landing, like a plane that just takes off again. So it is a very, where it is a picture where even the economists themselves are struggling to find answers to. So this is a graph, this is a table that we built in-house to monitor all the central banks' global inflation. So to look at it, if the row is very red, it means that it is very high above the respective central bank's target. If it's very blue, it means that it is very low below the central bank's target. So you can see for the last 1.5 years, the global economy has actually gone through a period of global disinflation. So in the case of US, you see inflation Jan 22 at 7.5%. It went to a high of 9% in June 22. Then the Fed started to hike rates. Then it actually brought inflation back down. So the cells start to get a little bit more white, but it is still kind of red. And it is actually very slow, this inflation progress in the last couple of months. And it is a similar picture for a lot of the other economy. So the only 3 economies that you see that are blue are China, Switzerland, and Italy. So China, as we know, is a different story there. It's a deflationary story in China now. So this is a very important table because it shows that while we have gone through a period of global disinflation, the pace has stopped and is proving very sticky. So if we look at the US CPI, this is the US core CPI data, the chart of it. You can see that it's very elevated at, I believe, 3.6%. And the blue bar is actually what is the contribution of core contributed by core services. And then you can see core goods is actually deflationary. So the bulk of the inflation now is coming from core services, meaning that this segment of the inflation is still running very hot. And if we were to look at a measure that the Fed is starting to put a lot more focus on, will be the super core CPI, that means you exclude housing. That component actually rose by 4.8% year on year, which is the fastest pace since May 2023. So it is a very concerning picture for the Fed. And you can see that the actual CPI is still some level away from their target. So the Fed looks at various measures. So they start to look at super core CPI. So they have a preferred measure, which is the core PCE method. Even if you look at the core PCE method, we are also above their target. And core PCE, how is it different from core PCI? They put less weight on shelter. But even with that, you can see that the core PCE is still high and trending high. Services inflation, which is very sticky, will be proving very hard to counter. It is still very, very high. So with that backdrop in mind, the US economy is very strong. Labor market is very tight. The inflation is still very, very high, especially dominated by services. It is very natural that the market start to reprice themselves. So you can see the gray bar is what market was pricing at the start of the year. So market at the start of the year was pricing that at the end of 2024, the market then expect the Fed to reduce rates by about 170 to 175 basis points. So if we assume that they move by 25 basis points per meeting, we are talking about 6 to 7 rate cut for 2024. And market at that time, they expected the first cut to happen in March. We are now in May. We have a few meetings that have gone past, and the Fed has not moved because the market have actually repriced themselves. So currently, the market pricing now, after the very strong data, after the very sticky inflation, market is currently expecting the Fed only to cut between 1 to 2 times for 2024. This is a similar picture for the rest of the central bank like Europe, Australia, Canada. It's a global disinflation that has stalled, and that's why there's a global central bank rate cut repricing of the probability as well. So this is the Fed FOMC dot plot. You can get this data from their FOMC website. So on the left, so to give some context, for the Fed, they have 8 meetings a year. But every quarterly, March, June, September, December, they will produce this, what we call the Summary of Economic Projection, SEP, and a dot plot. So this is a dot plot. So it basically shows every single member of the Fed, where do they see the rate of the Fed fund rate to be for this year, 2024, 25, 26. And then the median of those dots will be what is known as the median dot. So we can see that on the left, this is the dot plot for the December 23rd meeting, and for the latest, the March meeting, where they produced the SCP, where they updated the SCP projection, you can see that they have become less dovish compared to the December meeting, because the median has all shifted higher. So in a table form, you can see that for December 23 to the dark blue of March 24, this is the Fed's own projection where they think real GDP is going to be, unemployment rate is going to be, where inflation is going to be. So essentially, they have raised their projection higher to think, they think that the economy is going to do better. They think unemployment is coming lower. They think inflation is going higher. So with this, their own median dot projection has also shifted higher when we compare the March 24 meeting to the December 23rd meeting. So the median dots for 25, 26 have all shifted higher. So this was for the March meeting. For the next meeting in June 12th, they will have to produce this table again, where they will update their own projection, and I expect them to show a higher projection for some of the components here, and also importantly a higher dots for this. So this is the chart of the Fed fund rate. The orange line is what the Fed actually projects, which is based on the dot plot that I derived from their dot plot earlier. The yellow line is where the market is currently pricing. So I expect this orange line to shift closer to where the market is pricing when they publish their next SCP projections in June. So if you look at this Fed fund rate all the way back to the 1990s, you can see that although we are at a very high level now, we are actually lower than the levels in the 1990s or even back to the 80s, where interest rates were in the teens. You can see if we go back closer in time, in 2008, when the great financial crisis happened, the Fed took the rate all the way to zero. We were in a zero rate regime for very, very long, until rates started creeping higher after Trump got elected, and then to about 2%, and then COVID hit and rates were taken all the way back to zero until March 2022. Because of the inflation problem, Fed first raised the rates in March 22, and then June 22, because inflation was running at a very high rate of 9%, they started to hike rates 75 basis points per meeting for a few times. And it took us all the way back to the current level that we are talking about. So we are now at 5.25 to 5.5%. So now the big question on everybody's mind is interest rate going to go higher or lower? So market certainly think that the Fed is going to cut, but market was expecting a much deeper cut at the start of this year, but now they revised the projection. So do remember that this is very fluid on market expectation of the Fed, and this will actually move interest rate on the front end, and it will affect the whole term structure, and it will affect the futures price that you will be trading. So earlier I talked about the probability of the Fed cut. You can actually access the CME website for a very quick access. So CME has a tool called the CME Fed Watch tool. It's available on their website, and you can actually derive the probability from there. So you can see that market is saying that there's an 85% chance of first rate cut, because we are now at 5.25 to 5.5. There's an 85% chance in September that they will bring it down to by 25 basis points. So this is how you look at the probability here. So basically, market is saying forget rate cut in June and July, which I also agree. So now we move on to the hypothetical case study. So I'll be going through an example of going long. I'll be going through an example of going short, and then I'll be going through what we call market neutral, DV01 neutral curve strategy. So earlier I mentioned that US Treasuries are generally considered a safe haven. So in times of crisis like a war, stock market crash, the Japan Fukushima incident, market will panic. And what will they do? They always go and buy the safest securities out there like US Treasuries or gold. So this is what we call a flight to quality buying. It will result in higher US Treasury bond prices and lower yield. Remember the inverse relationship. But now we are talking about the CME-EU futures. So there's no inverse relationship here. You will be trading in a direct relationship. So on the 19th of April this year, traders believe that the Iran and Israel geopolitical tension will be worsening in the coming days. So to express his view, he thinks that it will worsen, the geopolitical tension will worsen. So it means that he expects people to be buying treasury bond up, thus lowering the treasury bond yields. So he expects lower yields in this case. So to express this view, in the CME-EU futures, he will be selling 100 contracts of the 10-year EU futures. So hours later, he was very lucky in terms of his trade being right, because Israel unfortunately struck Iran with airstrike, and there was a risk-off event in the market. So treasuries, gold, oil, all these instruments all soared in prices. The CME 10-year EU futures actually sunk. So the trader managed to buy back the 10-year EU futures at 4.512%. So recall earlier we said the DVO1 of the CME EU futures is $10. So how much did he make on this trade? So it's a very simple calculation, unlike the classic treasury futures. For the EU futures, simply calculate how much did how many basis points did it move. So in this example, simply take 4.624, you will trade to the third decimal point, minus 4.512, then you times 100. This gives you 11.2 basis point move on this contract. So he traded 100 contract. The thing moved by 11.2 basis point. And remember, 1 basis point is $10. He made $11,200 on this trade. So it is a very simple and neat calculation. So this is a graphical representation of the trade itself. He sold 100 contract at 4.624 here. Then Iran struck, market panic, the yields dropped all the way to a low of 4.5. He bought back at 4.512%. So this was an example. So the second case study we're going to go through. So the earlier example was to go long. The second case study now is one that we go short. So it is a hawkish repricing of the Fed. So we mentioned that the Fed has two mandates. One is maximum employment, one to maintain price stability. So if inflation prints are high and above the Fed target, market expect the Fed to become more hawkish, or they will be less dovish. So the hawkish repricing will result in a lower US Treasury bond prices and higher yield. So on the 10th of April, ahead of the March US CPI data, the trader believes that the actual inflation will be higher than what market expected. So to express the view, he bought 85 contracts. So I intentionally use 85 as an example because you can buy in one contract, you can even buy 82 contract, 83 contract. So he bought 85 contract of the 2-year EU futures at 4.755%. So the actual data came in at 3.5%, which is higher than market expectation of 3.4%. So what happened? Treasury bond prices sunk and the 2-year EU futures rose. As the market started to reprice the Fed, they pushed back the number of Fed rate cuts in 2024. So he bought at 4.755%, remember, to the third decimal point. He sold back at 4.933%. So again, it doesn't matter whether this is 2-year, 5-year, 10-year, 30-year, they all trade at a DVO1 of $10 per DVO1. DVO of $10 per basis point. So the number of basis points made on this trade, again, remember the third decimal point, you minus and then you multiply by 100 is 17.8 basis points. So profit on this trade, again, number of contract times the number of basis points times your actual DVO1. 85 contract times 17.8 times $10, $15,130. So it is a very simple calculation. And this is an example of shorting the bond, the EU futures. So graphical representation, again, he bought at the low here. at 4.755. CPI came out, interest rate shot up. He sold the contract here to realize the profit. So the last two examples would be a curve trade strategy. So before that, we need to understand what do we mean by duration neutral yield curve trade. So it is ideal for investors sometimes who do not want to take directional or outright risk. So the earlier two examples are outright risk. You basically choose to go long or you choose to go short. But they have a view on the curve. So generally, these curve strategies are structured to be DV01 neutral, meaning the long and short DV01 of the two legs will cancel each other out. So such yield curve strategy, they'll be steepener or flattener. They actually respond only to the change in the shape of the yield curve. So in the case of a parallel shift of the yield curve, i.e. the short and long end yields both move in the same magnitude, it's a parallel shift upwards or downwards, there will be no profit or loss. So a steepening yield curve means that the long end yields rise faster or they fall slower than the short end yields. So in the case of a yield futures, it simply means you sell 2-year yield futures, you buy the 30-year yield futures. Flattener would be the opposite. You expect the long end yields to rise slower or fall faster than the short end yields. So in the case of the CME yield futures, you will be buying the short end yields and selling the long end yields. So do understand that there are 4 different yield curve regimes. There'll be one for the flatteners, there'll be bull flattening, where it's led by the long end moving more, or bear flattening, which is led by the front end going higher than the long end. So bear flattening typically happen in the Fed hiking cycle, like what we see now. Hence, the curve become inverted in a bear flattening move. Steepening, there are also two. One is a bull steepener, one is a bear steepener. So typically, bull steepening is led by the front end yields dropping much faster than the long end yields, and this will happen in a rate cut scenario. And bear steepening means, for various reasons, you either think that inflation is going to be very sticky in the long future. You think that the U.S. fiscal creditworthiness is going to worsen. You demand a higher term premium for holding U.S. longer term maturity. Then the curve will bear steepen. So I have 2 case studies here. The first is a yield curve steepener. So the US debt is at a very, very staggering, 34 trillion. Debt to GDP is very high. IMF estimate fiscal deficit to be 7.1% in 25. Market participants think that this is not a sustainable debt trajectory. So they would expect a higher term premium, as mentioned earlier. So they think that the curve will be a bear steepening one. So to express this view, the trader, but he doesn't want to run any outright risk, so he wants to keep DV01 the same. So he will sell 100 contracts of the 2-year futures, and he will buy 100 contracts of the 30-year yield futures. So for the yield futures, it's very, very neat and convenient because they are the same DV01. So when you buy the same contract, your DV01 of this strategy naturally become the same. So for this trade, you will look at the initial yield and the final yield. So initial yield, you take the difference between the two. The curve is inverted, it's at 0.216%. And then the curve steepen out. At the final yield level, the curve is 0.113, which is the difference between the two. You can see that the change in yield for the 2-year, it went up by 7.3 basis points. The 30-year went up by 40.2 basis points. So as a strategy, because you are short one and long one, as a strategy, you are up 32.9 basis points. So even though you lose money because you are short the 2-year yield futures, but the 2-year yield actually went higher, so you lose money here, but you actually make more on the 30-year yield futures. So you actually make 32,900. So there are 2 ways to calculate the DV01 here. It's very simple. You calculate how much the curve has changed, and then you times the number of contracts, but you do not multiply by 200 here because you're actually taking the difference. So you multiply by 100 and the DV01 itself. Or you can do it the way I do it here. Show how much you make on each leg, and then you take the summation. So this is an example of a yield curve steepener. So you can see that this is a graphical representation. You see the curve used to be very steep. It has flattened a lot. And lately, in the last 1 year, market starts to bet that the term premium should actually trade higher. And so there are steepeners that are being put on, and the curve has actually steepened quite a bit. So in the last case study now is a yield curve flattener. So earlier we mentioned yield curve actually bear flattened on stronger economic data, your bull flattened on risk-off event. So in the hypothetical case here, the trader believed the incoming US employment inflation data will be stronger than expected. So this will be a bear flattener case because it means that the front-end yields will become higher. So to express this view, he actually bought 100 contracts of the 2-year yield futures, but because he doesn't want to have outright risk, he goes into a DV01 neutral strategy by selling 100 contracts of the 10-year yield futures. So similarly, the initial curve is at negative 0.216% inverted curve again. The final yield, the curve actually got more inverted because it got more negative. So as if you look at a respective component, the 2-year yield went up by 17.1 basis point. The 10-year only went up by 4.5 basis point. Hence the curve bear flattened. So the P&L, if you break into the respective component, he made money on the 2-year because he moved more. He actually lost money on the 10-year. But as a strategy itself, he actually made 12,600. So similarly, to calculate the profit, very simple, 100 contract times the actual movement on the curve, which is 12.6 basis point here, and the DV01, which is $10. So it will give you the same result of 12,600. So with this, you can see that it is a similar picture for the 210, was very steep, it flattened, steepened out in recent times, and then from here, it really depends on what is the incoming data before market decides it's going to go higher or flatter. So CME has a very, very useful tool. You can go to their website because not everybody will have access to Bloomberg or other information terminal. You can go to their website where they have a curve watch, the CME Treasury Analytics. You will see all the yield futures pricing there, and you can actually do your own curve analysis, which is the difference between a 2-year, 10-year, and any other tenor that you deem fit, and you can actually be monitoring and designing your own curve street strategy. So that would be all for my presentation. I'll be taking some questions now if there are any. So
all right. Yeah, thank you, Lawrence, for the sharing. It was very comprehensive, and I think the case studies really help to illustrate the value that yield futures can bring for traders and investors alike. And seeing that we have no questions from our audience and that time is about up, we shall conclude the webinar here today. Yep.
okay, thank you very much. Thank you, everybody.
All right. Thank you again, Lawrence, and thank you, everybody, for your time tuning in to this webinar tonight. We'll be sending everyone a link to today's webinar recording so you can watch the very insightful session again if you'd like to. And yeah, that's all for today. Thank you, everyone, and good night.